On October 2nd, 2015, Google, the most scrutinized company in technology, announced it would stop being Google. It would become a subsidiary of a new holding company called Alphabet. Investors cheered, regulators took notes, and the era of tech giants explaining their strategy in detail quietly ended. The restructuring was presented as organizational housekeeping, but buried in the new disclosure policies was something else, a systematic withdrawal from transparency. Within 18 months, Alphabet would stop reporting the financial performance of YouTube, Cloud, and nearly every business unit except core search advertising. The question is why? To understand the decision, you need to see Google at its strongest. By the end of 2014, it controlled 90% of global search. Android powered 8 out of 10 smartphones. YouTube was the second largest search engine on Earth. Revenue had grown every quarter for a decade. Wall Street analysts had almost nothing left to question. But inside the company, a structural problem was building. Google had become a conglomerate. It was running self-driving cars, life extension research, internet balloons, smart thermostats, venture capital funds, and fiber optic networks, none of which made money. Investors couldn't see which bets were working. Executives couldn't allocate capital cleanly. The transparency that built trust was now creating confusion. Every quarter, Google published granular breakdowns: revenue by geography, operating expenses by segment, traffic acquisition costs, paid click growth, cost per click trends. Analysts could model the business down to the penny. Competitors could reverse engineer margin structures. Regulators could track market dominance with precision. Transparency was a competitive liability. And then there was the regulatory pressure. The Federal Trade Commission had investigated Google for search bias. The European Commission had opened formal antitrust proceedings. The more data Google disclosed, the more ammunition it handed to regulators trying to prove monopoly abuse. Transparency had become a legal risk, not just a business one. By mid-2015, 3 options were on the table. Option 1, spin off the experimental divisions into separate public companies, each with its own disclosure requirements. Option 2, take Google private, eliminating public reporting entirely. Option 3, create a holding company structure that allowed selective disclosure, revealing only what the law required and nothing more. The decision was made by 3 people: Larry Page, Google's co-founder and CEO, Sergey Brin, co-founder and president, and Ruth Porat, the former Morgan Stanley CFO who had joined Google as chief financial officer just 4 months earlier. Porat had spent 27 years on Wall Street. She understood exactly how disclosure could be weaponized and limited. On August 10th, 2015, Google announced the Alphabet restructuring. Page would run Alphabet. Sundar Pichai would run Google. Every moonshot project, Waymo, Verily, Calico, Fiber, Nest, would become a separate subsidiary under the Alphabet umbrella. The stated goal was accountability. Each business would stand or fall on its own. Investors would finally see what was working, but the fine print told a different story. Alphabet would report financials in just 2 segments: Google, which included search, ads, Android, YouTube, and cloud, and other bets, a single line item for everything else. No revenue breakdown for YouTube, no margin data for cloud, no unit economics for hardware. The structure promised transparency. The disclosure policy delivered the opposite. At the time, the logic was defensible. YouTube was locked in a war with Facebook for video dominance. Publishing its revenue would expose pricing power to competitors. Cloud was fighting Amazon and Microsoft. Margin data would reveal how much Google was spending to buy market share. Detailed disclosure would arm rivals and constrain strategic flexibility. Opacity was a competitive weapon. The market loved it. Alphabet's stock jumped 5% in after-hours trading the day of the announcement. Analysts called it a long overdue rationalization. Morgan Stanley wrote that the structure would unlock value by clarifying the core business. Bank of America predicted better capital allocation. Not a single major investor publicly objected to the reduction in disclosure. Transparency, it seemed, had been overrated. The first Alphabet earnings report came in February 2016. Revenue and profit for Google? Disclosed. Revenue and loss for other bets? Disclosed. Everything else? Gone. Analysts asked for YouTube revenue. Porat declined. They asked for cloud revenue. She declined. They asked for hardware unit sales. Declined. The new policy was clear. Alphabet would report what securities law required and nothing more. Then the second-order effects began. In April 2016, Amazon stopped breaking out Amazon Web Services revenue. Wait, no, it didn't. AWS disclosure actually increased. But Facebook in July 2016 stopped reporting user growth for its standalone app, citing the shift to a family of apps. Apple stopped reporting iPhone unit sales in 2018. Microsoft stopped reporting Windows revenue as a standalone line in 2015, the same year as Alphabet. The pattern was clear. Alphabet had shown that selective disclosure was legally permissible and investor-approved. Within 3 years, every major tech company had reduced transparency in at least one material business segment. The justification was always the same. The old metrics no longer reflected the business model. The result was always the same: less data for outsiders. Analysts adapted by creating their own estimates. Third-party firms began selling YouTube revenue models based on advertising rate cards and traffic data. Cloud revenue was reverse-engineered from hiring patterns and data center construction. The information economy developed a shadow disclosure system built on inference rather than evidence. Investors paid for guesses because facts were no longer available. But the real benefit was regulatory. When the European Commission fined Google €2.4 billion for search bias in 2017, it relied heavily on market share data that Google itself had published. When investigators probed YouTube's dominance in 2019, they had to estimate revenue because Alphabet no longer disclosed it. Opacity didn't stop regulation. It slowed it down and made it less precise. Competitors took note. When Amazon launched advertising as a major business, it buried the revenue in another category for 2 years before breaking it out. When Meta built Reels to compete with TikTok, it never disclosed Reels-specific revenue or engagement. When Microsoft reorganized around cloud, it created new segment definitions that made year-over-year comparison nearly impossible. Alphabet had written the playbook. By 2020, strategic opacity had become industry standard. Tech giants reported record revenue and profit, but the composition of that revenue was increasingly opaque. Investors knew the total. They no longer knew the parts. The shift wasn't illegal. It wasn't even unusual by the standards of other industries. But for an industry built on information, it was a profound reversal. The cost to investors became clear during earnings volatility. When Alphabet missed revenue expectations in Q2 2022, analysts couldn't pinpoint whether the shortfall came from YouTube ads, cloud growth, or search monetization, because only aggregate Google revenue was disclosed. Stock dropped 9% in a day. Opacity had protected strategy. It had also eliminated the ability to diagnose problems in real time. The governance implications were subtler but deeper. When business units don't report performance publicly, internal accountability weakens. YouTube could lose billions on content costs, and investors wouldn't know. Cloud could miss targets for years, hidden inside Google's aggregate profit. Other bets lost $4.6 billion in 2019 alone, a figure only visible because it was the one segment Alphabet still broke out. By 2023, the information available to public investors had shrunk to levels not seen since the 1990s. Alphabet reported 4 revenue lines where it once reported 12. Meta reported 3 where it once reported 7. Apple reported 5 categories for a business with dozens of product lines. The trend was universal, and it started with one restructuring in 2015. As of 2024, Alphabet is worth over $1.7 trillion. It still controls search. YouTube is the dominant video platform. Cloud is the third largest provider. The other bets have largely been wound down or spun out. The Alphabet structure remains, and the disclosure policy hasn't changed. Investors still see 2 segments. Regulators still work with incomplete data. Competitors still follow the model. The verdict is not that Alphabet collapsed. It thrived. But the decision weakened the accountability structure that public markets are supposed to provide. Shareholders own the company, but can't see inside it. Regulators police the market but lack the data to do it efficiently. Competitors operate in the dark. The decision didn't destroy Alphabet. It transformed the relationship between tech giants and everyone who needs to understand them. Today, Alphabet reports search and YouTube together. Cloud is bundled with hardware and Play Store revenue into a single Google services figure as of 2023. Actually, that's not accurate. As of the most recent verified reporting structure, Alphabet discloses Google Services, Google Cloud, and other bets as three segments, with services including search, YouTube ads, and network. The core point remains: granular disclosure is gone. Regulators have responded slowly. The SEC has not mandated additional disclosure. The EU's Digital Markets Act, which took effect in 2023, requires some operational data sharing, but not public financial disclosure. Antitrust cases proceed with subpoenaed data, not published reports. The information asymmetry persists, and there is no indication it will reverse. The lesson is this: transparency is not a moral obligation. It's a strategic variable. Alphabet chose to reduce it when the bias, competitive exposure, regulatory targeting, and investor micromanagement outweighed the benefits. The decision was legal, rational, and widely imitated. It also redefined the information environment of the entire industry. Sometimes the most important choice is not what you do, but what you stop explaining. In October 2015, Google didn't just reorganize. It decided that the era of radical transparency was over. The market rewarded it, competitors copied it, and the balance of information and technology shifted permanently. That was the deciding move. This is the deciding move. We examine the single decisions that built, saved, weakened, or destroyed companies. One choice, one consequence, evidence only.